Hello and welcome to our latest market update video brought to you by the Live Trade Room. Now today is Friday the 8th of December 2023 and the whole point of this short video is for us to discuss how to prepare for today's US job numbers. We've had some interesting job related data due out over the course of this week already. We'll identify what does it suggest. What we can expect from today's non-farm payroll is probably a little bit more volatility than we've seen for quite a while, and we've got a bit of a binary decision to make, and we'll break it down for you in a little bit more detail. So let's get straight into it. Okay, so hello and welcome. Thanks very much for joining us. We've got an interesting news event this afternoon, so we want to look in detail in terms of how do we prepare for this particular news event. It's US job numbers, non-farm payroll. So let's break it down for you in a little bit more detail. And what we can expect over the course of the afternoon is probably a significant market reaction, and we're going to explain why. So if we can start, of course, with our risk warning. Just take a brief moment to familiarize yourself with our risk warning currently up on screen. Do feel free to pause the video if you need. Okay, so let's get straight into it then. We'll start with the actual news event itself, and there's a few elements that we want to draw to your attention. So it's this event down here, Friday the 8th of December, non-farm payroll, non-farm employment change numbers. The forecast is that we're likely to see 148,000 jobs added to the US economy. And we've also got the unemployment rate, which is expected to remain at 3.9. And the average hourly earnings looks like we're going to see a little bit further inflation on people's earnings, which is an interesting dynamic. It is a dynamic which could become a bit of a problem for the Fed and more so the markets in terms of their current expectations. So just before we discuss non-farm payroll, I just want to take you back to some of the earlier job-related news events, and the first one's on Tuesday, the 5th of December. JOLTS job openings. So how many jobs are available in the US? Well, they're much less than what was anticipated. We're still up at really elevated highs, but you can see we were forecasting 9.31 million jobs available in the US economy. There's actually coming in much lower, 8.73. So what that suggests is there's a bit of a softening. Companies aren't as aggressive in terms of the number of jobs are available. They're probably tucking their, they're not as being as expansive perhaps as they previously were. That's probably a good way to put it. So in addition to that, on Wednesday, the 6th of December, we had ADP non-farm employment change numbers. We're expecting 131 private sector jobs to be added. The number came in way below. So there's already a correlation between the number of jobs available and the actual employment change number. So this is the prelude. The ADP is the prelude to non-farm payroll, and the prelude is suggesting that actually the employment backdrop seems to be getting worse, beginning to loosen, whatever kind of wording you want to use. Now, the reason why that's of importance, and then we go to unemployment claims. Now that came in very much in line with expectations, so no major deviation there. We are seeing a very slight uptick more recently on the number of unemployment claims. We were kind of averaging around sort of 210, 200,000 to 210. Now we're squeezing a little bit higher. We're up to 220, so we're not quite as high as we were last year, but at the beginning of the year, but we could be edging a bit closer to that. But really, no major sort of guidance either way as far as unemployment claims are concerned. So that brings us nicely into these non-farm employment change numbers. So let's go back to what the Fed are wanting to see happen. They have a remit to maintain as low unemployment as possible for the US economy. So they have a real focus on jobs, wanting to maintain jobs and keep inflation under control. So they've raised rates to keep inflation under control, and inflation has come down from 9.1 to just over 3%. So they've had considerable success in that strategy and approach. But what we've seen on the job side is we've not seen that much loosening just yet, but we're watching very carefully to see at what point will these markets and the jobs market, will it begin to loosen, i.e. Less employment, slightly more unemployment, and that is regarded as being deflationary in nature. So the more people that have jobs and the more that they get paid, the more likely they are to actually pay the current higher prices. So low unemployment and higher wages are very inflationary in nature. So that needs to be understood, because the Fed want to make sure that they limit inflation, and areas of concern to the Fed would be the jobs market, because more people have jobs and they're earning more. So that's an inflationary force that they kind of want to dent. And to do that, you need to see unemployment numbers increase. You need to see the unemployment rate increase as well. We've already jumped off the lows from 3.6, I think it was, at the lows. We're bouncing off these lows in here. Oops. So 3.4, 3.6. So we have bounced off 3.5, and there is a very small uptick. Nothing hugely meaningful. There's still some argue that the US economy is still in full employment. But you can't disagree with the fact that the unemployment rate is increasing slightly. So those that are advocate of what's called a soft landing just expect kind of softer unemployment rate to just tick very so slightly higher. There are some that are advocates of, a sharp uptick once these delayed lags start to filter through from the Fed. If you look here at the bottom hand corner of this the screen here. Oops. Okay, so sorry, here we go. So on the left-hand side in here, we've had the Fed and other central banks basically go from 0 right the way up to 5.5%. So we've been on this rate hiking cycle. Now that rate hiking cycle looks like it's coming to an end. We're seeing the Fed, we're seeing other central banks all pause up at these fairly significant levels without the wheels coming off. So that's the good news. The bad news is, at what point do the Fed and other central banks make decisions regarding cutting rates? And this is the narrative that's taking control of these market conditions. Sorry, let me go back to today, the 8th of December. So it's this unemployment rate. So currently 3.9. Will that tick a little bit higher? And non-farm payroll, will we come in line with expectations? Will they come in above expectations or below expectations? And this is where the decision-making becomes quite binary. So if we get a non-farm employment change number above 200,000, it means that there's more jobs added than expected, and that's still quite a strong jobs market in the US. So under a situation like that, that would be a good news event on the surface, but we're very likely to see a negative market reaction. So do bear that in mind. We're going to just remove these, and I'm just going to put that in place. So if we get a solid, strong jobs number, we'd probably expect, whether we'll break these lows and we'll rally to the downside remains to be seen. There would certainly be the potential for a decent rollover to the downside if we break out of this 3-week sideways range, as you can see up at these levels. However, the other side to that argument and discussion is if this unemployment change number comes in below expectations, and you're probably looking at 160 and lower, would probably create further upside. So that's a bad news story, which we would anticipate, as far as the markets are concerned, to see a good, strong, positive market reaction. So if it's bad news on the employment change number, we can expect a positive market reaction. And if it's good news, we probably expect perhaps a shorter term weakness, and that could turn into something a little bit weaker, potentially if we start seeing all these technical rollovers to the downside as well. So that is the binary decision that we make, and a way in which we can sort of summarize a lot of that is by focusing on the narratives that drive these markets. So I'll leave you with the contemplation really that these markets have been over the course of November, and we haven't done too much so far in December, but we are expecting further upside because of this narrative here, this dovish Fed narrative, the fact that these central banks are very likely to pivot with regards to rates. So that's going from 5.5% in the US, and it's coming down. We've already had some numbers from the ECB that we might see 150 basis point reduction in interest rates for the ECB, which would bring their interest rate down from 4.5% down to 3% by the end of 2024. So we're now finally entering this rate pivot narrative. This is what's been driving momentum, broadly speaking. So as a result, what are we looking to see happen? We're looking to see, for risk on market conditions, we're looking to see an appetite for risk. Inflation's dealt with, unemployment is very, very low, economic output is reasonably solid, and we're still waiting for weaker economic data to filter through. So under a condition like that, especially with lowering interest rates, it does create a bit of a positive spin for traders and investors to start adopting a little bit more risk. So we're looking for that risk on trade. As a result, we're looking to see the US indices push higher. We're looking to see softness in the US dollar. So we've got a few dollar weakness trades currently set up. US bond yields are continuing to make progress to the downside. Let me show you the 10-year, for example. It's quite a good chart to just show you where we're at. We've been rolling. We were up at 5% if we went back to mid-October. Now we've rolled over right to the downside, and this is negatively correlated. If you see bond yields rolling over to the downside, that's broadly a positive news for equity markets. So that's another element that's kind of supporting this US indice higher narrative and this risk on narrative. And then commodities higher. They've been a little bit of a mixed bag, to be fair. Commodities, we've seen a massive spike in gold. We've seen oil markets absolutely continue to roll over to the downside. So negativity on oil, positivity on gold, but there's a lot of volatility in there as well. So we've just got to sort of cherry pick the right trades at the right times. But hopefully, this is the narrative that we're focusing on. So what do we need from these non-farm payroll numbers today? We actually need them to come in below expectation. That would reinforce this trade, and that is a potential outcome that we're going to sort of prepare for. And if that's the case, we'll probably get some really decent trades off today. So that's the outcome. So hopefully we've explained the concept of today's non-farm payroll numbers, and we're sort of breaking down for you a little bit in terms of how we expect to trade that particular news event. Okay then, so on that note, thanks very much for joining us. Any questions, feel free to email us at support@thelivetrading.com, and we'll get back to you as soon as we can if you do have any questions about anything covered. So look, all that's left for me to do now is to thank you very much for joining us. Do stay tuned for our next video. We'll get that out if there is some interesting sort of market update to inform you of. Now, if you are interested in learning how to trade, you can access one of our discounted live trading and education bundles on our website. It does start from just $59 per calendar month, so hopefully you will find that useful in terms of being able to not just broadly talk about the opportunities, but actually application about trading decision making, and we can help you with that process. So for more information, just go to thelivetrading.com, and we look forward to hopefully seeing you soon. For everyone here at The Live Trading, do take care. We'll speak soon. Bye for now.